Welcome to The Explainer. Today, we're stepping right into the shoes of a professional equity analyst. We're going to run a frankly fascinating company through a really rigorous valuation gauntlet. We're talking about Golar LNG, ticker symbol GLNG. Using their latest comprehensive financial metrics, we're going to try to calculate the true intrinsic value of this stock. And we're not just relying on one model here. No way. We're going to cross-examine this business using absolute valuation, relative valuation, and asset-based valuation to find out what's really going on behind the ticker tape. Let's get to work. Right out of the gate, we are hit with a massive, glaring contradiction. Get this. Golar LNG boasts a market capitalization of roughly $5.67 billion. Sounds great, right? Yet their trailing 12-month free cash flow is negative $412.5 million. Seriously. So how exactly do we value a company that the market clearly loves, but that is literally bleeding cash today? Well, that's exactly the puzzle we're going to solve.
Okay, let's dive into this. Here is our roadmap for the analysis. First, we'll establish the baseline. Second, we'll tackle absolute valuation. Third, we'll look at relative valuation against peers. Fourth, we'll strip it down for an asset-based valuation. And finally, we'll synthesize it all for our final verdict.
Starting off with Section 1, the Golar LNG baseline and our current reality. $55.70. I want you to keep that number in the back of your mind. That is the last closing price of Golar LNG, and it's our target. Every single calculation, every model, and every projection we run today is going to be relentlessly tested against this exact number. We need to figure out if this stock is fundamentally undervalued, overvalued, or maybe fairly priced.
Now, pulling up the trailing 12-month numbers, you immediately see why valuing this company is going to be, well, incredibly tricky. Golar brought in $393.5 million in revenue and actually posted a positive net income of $65.6 million. But like we just talked about, that free cash flow is deeply, deeply in the red at negative $412.5 million. And on top of that, the price-to-earnings, or PE ratio, is sitting at a towering 92.83. Basically, this tells us right away that the market is completely shrugging off the current operational reality because they're expecting some massive, explosive growth in the future. Let's move into Section 2, Absolute Valuation, where we try discounting the cash.
Now, put on your analyst hat for a second. Reviewing the available tier sheet data, we actually have a ton of trailing metrics, but we are missing some explicit multi-year management projections and a stated weighted average cost of capital. So what do? We build a bridge. We're going to apply some really sensible default assumptions for a company of this size in this industry. We'll use an 8% cost of equity, a fairly conservative 2% terminal growth rate, and standard industry debt costs. Let's see what happens when we plug these into the models. We usually start with the absolute gold standard, the discounted cash flow, or DCF model. Step 1 is checking our free cash flow, which, as we know, is wildly negative. And here's the thing, you just can't discount negative cash flows to a positive present value without projecting a massive, highly speculative turnaround. So our standard FCF fair value completely breaks down. It's literally just not applicable. But our data gives us a workaround, an EPS-based fair value. By discounting projected earnings per share instead of actual cash, the model actually spits out a fair value of $80.44. That implies a nearly 31% margin of safety from our current trading price. It is a super strong bull case for sure. But remember, it relies entirely on those accounting earnings eventually becoming actual tangible cash.
Okay, let's try a totally different absolute model to see if it holds up. The dividend discount model, or DDM. This one values the stock purely on the present value of its future dividends. Right now, Golar has a dividend yield of 1.80%, which translates to about $1 per share annually. But crucially, the data shows a 0% compound annual growth rate for dividends over the last 3 to 5 years. So if we take that $1 payout and divide it by our assumed 8% cost of equity, assuming absolutely zero future growth, the DDM gives us an intrinsic value of just $12.50. Yeah, $12.50. That is a really staggering drop from that $55 share price.
So because our first two models gave us basically completely opposite answers, we need a tiebreaker. Enter the residual income model. This one starts right from the current book value. With the stock at $55.70 and a price-to-book ratio of 3.06, we can reverse engineer a starting book value of roughly $18.20 per share. Next, we check their return on equity, which is a pretty meager 3.56%. And here is the harsh analyst reality check. Because that 3.56% ROE is way lower than our assumed 8% cost of equity, Golar is technically destroying economic value right now. The residual income is negative, which actually drags our intrinsic value calculation below that initial $18.20 book value baseline.
Let's shift gears to Section 3, Relative Valuation, looking at peer multiples. When we start comparing Golar's metrics to its industry, the disconnect becomes glaringly obvious. Golar's trailing PE ratio is nearly 93, and its forward PE is almost 68. Plus, its enterprise value to EBITDA ratio sits at almost 39. Now, in the energy and shipping sectors, standard peer averages usually hover way lower, around 15 for PE and maybe 10 for EV to EBITDA. If we were to apply those standard, boring industry multiples to Golar's current earnings, the implied stock price would absolutely crater, landing far, far below our current trading price.
So the crucial point is this. Relative valuation explicitly shows us that Golar LNG is trading at a massive premium. Investors are absolutely not buying this stock for what the company is doing today. They're buying it for what they truly believe it's going to do tomorrow. The stock is essentially priced for absolute perfection.
Moving on to Section 4, Asset-Based Valuation, or NAV. Let's define what we're looking at here. We're talking net asset value, or NAV. This is effectively the liquidation or replacement value of the entire company. Basically, if Golar LNG just stopped operating tomorrow, paid off every single debt, and sold off all its physical assets, what exactly would be left over for the shareholders?
Well, the numbers paint a pretty sobering picture of the raw assets. Golar carries a somewhat elevated debt-to-equity ratio of 150, meaning they're relatively leveraged. Their enterprise value to assets ratio is 131. That indicates the market is currently valuing the company at roughly a 30% premium to the raw assets actually sitting on the books. And as we calculated a minute ago, that underlying book value per share is hovering right around $18.20. That right there is our hard floor. If the whole growth narrative collapses tomorrow, this is roughly where the tangible physical asset value sits.
All right, bringing it all together in Section 5, Final Synthesis and Verdict.
And this brilliantly illustrates just how complex equity analysis can be. I mean, look at the spread of our results here. The current market price is sitting at $55.70. Our EPS-based DCF model suggests it could actually be worth over $80. But then the dividend discount model drags it all the way down to $12.50. The raw asset value anchors it around $18.20. And relative valuation against peers suggests it is severely overvalued compared to normal industry standards.
So how on earth do we reconcile this? Well, we have to weigh the strengths and weaknesses of each model based on the actual business. The DDM and residual income models give us super low values because Golar currently has low dividend payouts and a low return on equity. That means these specific models might actually be a bit too punitive for a company that's heavily reinvesting for the future. The relative valuation is totally skewed because the market clearly views Golar as a unique growth play, not just some legacy shipping utility. Really, the EPS-based DCF is the only model that supports the current price. But man, it heavily relies on those projected future earnings materializing flawlessly to replace today's negative cash flow. Which brings us to our final verdict, and a pretty big question for you to consider. The fundamental data we just ran through suggests Golar LNG is overvalued today based purely on its underlying assets and current cash flow. To buy in at $55.70, you've got to have immense conviction in that $80 DCF upside. You have to fully trust that their future earnings are going to absolutely explode to justify this massive premium. So, as an investor, you have to ask yourself, is the market's aggressive growth pricing totally justified by an impending boom in natural gas logistics? Or, with an $18 underlying book value and deeply negative cash flows, is a really harsh fundamental correction looming on the horizon? Think about it. Thanks so much for joining me for this explainer, and I'll catch you next time.